Good morning, I'm Robin Gibson, and this is your Harvard House Money Morsel. Welcome back to the Money Morsel. Please don't forget to like, subscribe to the channel and click the bell so that you can get the regular notifications of when we release a video. I'm sitting again with Michael Porter, Chief Investment Officer. Morning, Michael.
Morning, Robin.
Michael, we've explored probably ad nauseum to the viewer inflation, interest rates, geopolitics, but during this time other things have been happening, and we've recently started to see reporting season coming in for the property sector. Can you give us an update of what's happening in property? I know many of our clients are invested in property, and it's a key asset class for us.
Sure. Morning, Robin. Morning, everybody. If you just think back, property was the best performing sector of 2021, 37% return, and that after it being the worst in 2020 when the pandemic really hit. And so this year, I think things have come down to earth a little bit. I mean, the property sector is probably off about 8% for the year to date. So I think there's a couple of things at play here. I think firstly, the strength of the rand has sort of weighed on some of the property counters because a lot of companies have diversified offshore, so there's probably a little element of that. But yes, there's essentially two reporting periods during the year. So the sort of December year-end companies report in March, and those that reported then, definitely retail. The retail sector is back again. It's doing well. Generally, retailers are doing pretty well. There's much more discretionary spending in this economy than what people give credit for, which is something we can delve into, but I think it flows very well into our supported consumer theme that we've talked about quite regularly. The other aspects of the property market for companies that reported in March were so-so. Industrial's pretty strong, the warehousing logistics side, as everybody moves to this to cope with supply chain challenges and online and everything like that. And the office market is still weak. Now, we're about to enter another big reporting season now. So all the companies that either a February or March year end are going to be reporting in the next couple of weeks. But some of them have released trading updates, and we've had discussions with quite a few companies leading up into that. And yes, generally, I think there's some very positive things that are coming out of it. So generally, when a lease comes to an end, you'll sign you'll try and retain the tenant, you'll try and sign a new lease, and depending on what the rental they're paying, the new lease might be at a lower level, and that's called a negative reversion, where you're actually taking the rental down by 20% just to retain the tenant, and then that rental then grows off that base for the duration of the lease. So rental reversions are definitely getting less. So that whole bottoming out of rents appears to be happening at the moment, which is very positive because that will mean that income will start rising again. Vacancies are definitely falling. And then in some forgotten asset classes like residential, for example, a fund that we quite like is Octodec. They have residential properties in Pretoria and Joburg. But with the universities opening up again, residential's picking up. People are definitely getting back to work. The office sector is definitely coming back to life. Not to say that the office sector's woes are over, because there's a lot of oversupply, but companies are definitely getting their employees back to work. It's not just work from home. It's 2-3 days a week. But because people are moving around and traveling a little bit, that's also fueling them, the shops in those kind of areas, or the coffee shops, or all the other bits and pieces that you do when you're out and about. If you're just stuck at home all day, you don't go to the coffee shop or whatever the case is. So there's definitely been an improvement.
Awesome. So for many of our investors who are reliant on listed property for their incomes, are we starting to feel a lot more optimistic in that space? And are we seeing some of those incomes come back quite strongly?
Yes, Robin. Income growth is definitely there again. Most companies, I suppose there's two things to probably look at. The first thing is that quite a few companies during the pandemic and even last year decided to only pay one dividend a year to see how the year panned out before they committed. Most of the companies that did that are now reverting back to 2 dividend payments a year, which is a very good sign that they're confident that their underlying business is improving. Over the whole course of the pandemic, debt levels were reduced. So interest rates are rising. There's always a risk for listed property that interest rates are rising at the moment, and we expect the Reserve Bank to do another 50 basis points this week. Well, to do 50 basis points this week. But, all these big funds have hedged their debt. The rising interest rates don't carry the risk that they used to do in sort of 15, 20 years ago. And yes, rentals are rising again. So definitely property income is rising, distributions are rising, and there's a buoyancy in the market that hasn't been there for a couple of years. So it's not to say that property is going to storm away, but the underlying fundamentals are improving all the time. And the balance sheets are stronger, the companies are stronger, they're well able to weather a storm.
Well, it's really exciting to hear that property as an asset class is not dead. Thank you for tuning in. Please don't forget to like and subscribe, and enjoy the rest of your day. Thank you.